Good morning, good afternoon, good evening, traders from across the globe, and welcome to the 1000, well, imagine this, it's my 1100th video. Wow, 1100th video, could you imagine? Woo! All right, here we are, traders. Video number 1100. This video is being filmed on Sunday night for trading Monday. That would be November 4th, 2013. Traders, as you know, futures trading can be extremely risky and cause substantial financial loss, and futures trading is certainly not suitable for all trading accounts. Traders, here we go. This video again is for trading on Monday. That's the 4th. We have a two-sided OMNI. A two-sided OMNI. Very, very rare occasion. So OMNI expects the market to come down first, turn around and end up back on the upside before Monday is over. If you'd like to learn more about how we plan on handling the two-sided OMNI in the emini S&P, come on down to livewithoscar.com, jump into my free chat room and allow me to help you understand why we see this as a two-sided OMNI. So that's your emini S&P, traders. There's some other very interesting charts I'd like to show you. Take a look at this one. Traders, the gold chart that I showed you a few days back, if you recall, I put this chart before your eyes and it basically looked like this. And I said, traders, I think this is it. I think we're done. I think it is time for us to sell gold. And OMNI put out a sell signal, of course. And the market since then has done this. Bravo for technical analysis, traders. That was right on. That was beautifully called. So there you are. We expect lower on Monday in the gold. The OMNI has another red OMNI for gold. This, my friends, is a head and shoulders continuation pattern. Why is it a continuation pattern? Because we've been in a bear market in gold for quite some time. It stops to build this consolidation pattern or continuation pattern, which basically resembles a head and shoulders. There's a left shoulder, the head, and a right shoulder. And as you can see, we basically hit the resistance on the same area in the left shoulder as we did in the right shoulder, and down we are starting to come. The projections are lower. Let me show you what it looks like on the weekly. This is gold on the weekly bar chart, traders. The gold weekly bar. You've seen this chart many, many times now. Here's where we stand. Okay, we knew we had the plateau area. We looked at that. We knew we broke the 200 bar moving average, which is extremely rare if you're going to remain in a bull market. So we broke the 200 bar moving average on the weekly, so that turns us bearish on top of this topping pattern here. Then we come down all the way down here, and then we make this on a weekly, of course, head and shoulders pattern. In the last 2 weeks, we went up and did a head test, failed at the head test, and started to break back down. Your target now is about 1185 on this move. If it starts to move down, we do expect that gold will. So there's our update for our gold traders. Okay, let's move to a very interesting chart. Traders, look at this chart. I showed this chart to you on Thursday night into Friday. I posted it on Facebook. I showed it to my Omniacs, and the question was, is this a real bear flag? If it is, it sure looks like a big one, right? Look at the size of this bear flag, my goodness. So that was Thursday that I showed it for trading possibly Friday. This is what happened on Friday. Look at this day that we had, my goodness. So it is a real bear flag after all, and down we should go in the soybeans for trading on Monday. But my goodness, how well does this stuff work? This was the discovery when we seen the flag and called for it. Plus, we are below the 200 ball moving average. So we see a bear flag, we talk about it, we post it at the OMNI, we post it on Facebook, and we mention if it's bearish, it should come through. And then this is what happens. I mean, is that wonderful technical analysis, traders? That's just fantastic. I love technical analysis. What a roadmap to what should come next in our U.S. indices. Then we have, or in, of course, in all our markets, you have, this one is in soybeans. Then, traders, we have another interesting chart that we looked at together, and that was our 30-year T-bonds, and I promised I would keep you updated on this. Now, you are looking at a weekly chart where each one of these bars represents a week's worth of trading in the 30-year T-bonds. The market comes down to the 200 bar moving average, which is this teal average that you see right here. The market comes down to it. Usually bonds will hit it for about 18 weeks of whipsawing, and then it has a big rally up. Comes down a year and a half later, has exactly 18 weeks of whipsaw, and heads back up. Comes back down. Now, this was 2011. All the way at the end of 2013, it comes back to the 200 bar moving average, and it spends 18 weeks whipsawing. But now this is week 19, or was week 19 last week, and we got down here. This now, my friends, is week 20. So no longer is it week 19. We can cross that one out and call it week 20. And that, my friends, is becoming something of significance. If we spend another week or so below this 200 bar moving average, I assure you the fund managers will come through the woodwork. Then, if you really want to take a look at this, you can absolutely call this a bear flag. And that's interesting as well, because it looks like we're starting to mark some time below that 200 bar moving average. And if that's the case, and this turns out to be a bear flag, which I expect it will be, your flagpole represented by this, your flag right here, that is bearish as well, building below the 200 bar moving average. And remember, forget about the flag. Usually it's only 18 weeks and then a rally, 18 weeks and then a rally. We are now at week 20 and no rally has come yet. Very, very interesting there, traders, undoubtedly. So don't forget that there's a lot going on out there. I want you to absolutely make sure that you do this, because these days are tricky. These markets are treacherous, and you need some help out there. So come on down to livewithoscar.com and make sure you join me in my free chat room. It costs you nothing. I'm a 32-year pro at this, and I love helping out my ever-growing army of Omniacs. Traders, always remember to try to stay as calm as you can when you're in these positions. I know that's not an easy task, but try to stay calm, and always try to keep your emotions out of making trading decisions. It's one of the reasons why I tell you to put your stops in and to put them in first. And when you do put your stops in first, you know what that means? That stops are in. Emotions are out. Rock and roll, traders. That was my 1,100th or 1,100 of these crazy videos. I promise to keep them coming to you night after night, week after week, staying on these markets, hoping to keep you in tune with the way technical analysis works. Traders, once again, a round of applause to you. Thank you so much for viewing my videos and your ever undying support.